Welcome to the Deep Dive. We're your shortcut to really getting what's going on behind the curtain in some of the world's most critical industries. Today, we are diving deep, really deep into general dynamics, the global aerospace and defense giant.
Yeah, a massive enterprise.
Exactly. And our mission today is pretty straightforward. Unpack their second quarter 2025 results, look at their guidance. We want to pull out the really important bits of knowledge, the key insights from their earnings call, their reports.
Think of it as getting you right up to speed on a really vital company.
Perfect. So let's jump straight in. The headlines were pretty attention-grabbing, right?
Oh, absolutely. When we say impressive, we mean it. GD had a genuinely standout quarter. It really showed some strong momentum. Their revenue, for starters, soared to $13 billion.
$13 billion, wow.
Yeah, and that's up 8.9% from the same quarter last year. It's not just a number, right? It signals real market demand for what they do. They're grabbing market share.
Okay, $13 billion, up almost 9%. It's a strong top line, but you said it gets better.
It does. Look at the earnings per share. The diluted EPS, it hit $3.74.
$3.74. And that was up how much?
Up 14.7%. And importantly, it beat the street consensus by a good $0.19.
19 cents beat, that's notable. And operating earnings.
Also strong, climbed almost 13% to $1.3 billion. Net income just nudged over $1 billion.
Over $1 billion in net income. And they improved margins too, didn't they?
They did. A 30 basis point expansion in operating margin got them to a solid 10.0%.
Right. The CEO summed it up pretty well, I thought. Called it a wonderful quarter, said it exceeded our expectations.
Yeah, and a very good first half overall. You really get that sense of confidence.
Okay, so strong financials. But what's really fueling this, what's underneath? I heard the order activity was something else.
Oh, it was huge. That's where it gets really fascinating. They booked over $28 billion in new orders just in Q2.
$28 billion in one quarter.
Yep, which gave them an overall book-to-bill ratio of 2.2 to 1.
2.2 to 1. So for every dollar they billed, they brought in $2.20 of new business.
Exactly. That's a powerful sign for future growth. And it pushed their total backlog up to a record level.
A record? What was the number?
$103.7 billion.
Whoa.
Up 14% year over year. An all-time high for them.
Okay, that's the firm backlog. What about the bigger picture, including options and things?
Right, the total estimated contract value. That includes options, IDIQ contracts, the flexible government ones.
Indefinite delivery, indefinite quantity, yeah.
That also hit an all-time high, over $160 billion, $161.2 billion to be precise.
Just incredible numbers. So this massive pipeline, what does it really mean for the company, for the sectors they're in?
Well, it means stability, visibility for future revenue, future earnings. It shows demand is incredibly strong. But to really understand it, you got to look at the financial engine, right? The cash flow.
Cash is king, as they say. How did they do there?
Really well. It generated $1.6 billion in operating cash flow for the quarter.
$1.6 billion. How does that compare to earnings?
It's actually 158% of net earnings.
Yeah.
Very robust.
And free cash flow. After CapEx.
$1.4 billion. That works out to a 138% cash conversion rate for the quarter, which is, highly efficient, turning earnings into actual cash.
Okay, that's Q2. What about the first half overall?
Already at $1.1 billion in free cash flow year to date. And they said that's well ahead of what was planned.
So they're tracking ahead. What's the expectation for the full year then?
They expect a strong second half. Most of the cash usually comes in Q4 for them, but they're now aiming for a 90% cash conversion rate for the full year.
90%?
Yeah.
And that's an improvement on what they thought before?
Yeah, it's better than their original forecast, so cash generation looks really solid.
Any specific factors helping that cash flow besides just strong operations?
Well, one thing they mentioned is the recent tax legislation, the reversal of R&D expense capitalization. That's expected to provide a cash benefit.
Ah, right. Though they're still figuring out the exact timing and amount.
Exactly. Still being estimated, but it's a positive tailwind for cash.
Okay, so generating lots of cash. What are they doing with it? Where's the money going?
Well, capital expenditures, CapEx, was $198 million in Q2.
Relatively modest for their size.
For Q2, yeah. But they expect higher spending in the second half. They're targeting a bit over 2% of sales for the full year, so investing back into the business.
Makes sense. What about returns to shareholders? Dividends?
Definitely a priority. They paid out $402 million in dividends in Q2.
And they just raised it again recently, didn't they?
They did, back in March. It was their 28th consecutive annual increase, so a very reliable dividend payer.
Okay. And share buybacks? Any activity there in Q2?
Interestingly, no repurchases in Q2 itself. They mentioned the cash profile at the time, but they were active in the first half overall.
How much did they buy back in H1?
$600 million. Still returning cash that way too, just not in Q2 specifically.
Gotcha. And what about managing debt?
They were pretty proactive there. They had $750 million in notes mature in May, and they refinanced that. And importantly, they cut their net debt by $1.2 billion just from the last quarter.
$1.2 billion reduction. So where does net debt stand now?
Down to about $7.2 billion. Puts them in a good liquidity spot. No more debt maturing until next year.
All right, so a really strong financial footing. Let's break down the actual business segments now. The engines driving this, maybe chart like Aerospace, Gulfstream. How do they do?
Aerospace had a genuinely solid quarter. Revenue hit $3.06 billion.
Up about 4.1%, right?
Exactly.
Yep.
But the operating earnings, that's where you saw a bigger jump. $403 million, up 26.3%.
26% earnings growth on 4% revenue growth. That implies strong margin expansion.
It does. A really notable 230 basis point increase in operating margin, landing at 13.2%. That's impressive efficiency.
Okay, so Gulfstream. Deliveries are key there. What's happening with the planes, especially the new ones?
Yeah, they delivered 38 aircraft overall in the quarter.
Dang.
And notably, they ramped up deliveries of the new G700. They delivered 15 of those.
15 G700s. That's up from last year and last quarter, I think.
Right, 4 more than last year, 2 more sequentially. Now, that was kind of offset strategically by the final deliveries of the older, high-margin G650s. They're transitioning the lineup.
Makes sense. And the supply chain issues we always hear about. Any improvement?
Seems like it. They said it continues to improve. Fewer faults found on the planes, and the ones they do find are getting easier to fix. So they sound pretty confident about hitting their delivery plans.
Good news. And the G700s that needed retrofits or engines, all done.
Yep, all those have been delivered to customers now. Cleared that backlog.
Okay, so G700 ramping up, G650 phasing out. What's next? The G800.
Exactly. That's a big one. Initial deliveries are starting now in Q3.
Starting now. How many this year?
They're expecting about 13 G800s for the full year. And this plane, it was designed to replace the 650.
Right, the successor.
And here's a kind of interesting little tidbit. The first 20 G800 orders, they're going to existing G650 owners.
Huh, loyalty. Or maybe just upgrading the fleet.
Could be both. And they're also seeing significant interest from Fortune 500 companies. So market appeal seems strong.
Okay, G800 deliveries starting.
Mm.
But new planes often mean margin pressure initially.
That's the catch. Those first G800s, they won't carry the super high margins the G650 had, not right away. So yeah, that will put some pressure on margins in the second half.
So what are they expecting for H2 margins then? A dip?
They think Q3 margins will probably be similar to Q2, so still pretty good. But then a stronger Q4 as the G800 production gets, more efficient up the learning curve.
Right. Which brings up the big question everyone asks about Gulfstream. When do those margins get back to the high teens? Above 15%?
Yeah, the golden question. It sounds like it's still a bit complex. The guidance was sort of maybe 2026, but for sure in 2027.
Okay, 2026 or 27.
Yeah.
But then maybe another dip.
Potentially, yeah. They mentioned some degradation again in 2028 because the G400 deliveries will start then, and that's expected to be a lower margin aircraft. So it's this dynamic mix over several years.
It's always about the mix, isn't it?
Very much so. The long-range jets, like the 700 and the new 800, they command the highest margins. Then you've got the 600, 500, 280. Managing that product mix is absolutely key to their profitability.
But you're saying aircraft deliveries, that's not the whole story for aerospace margins, right?
Right.
There's the services side, too.
Exactly. People often forget that. It's a huge piece. Over $3.5 billion in sales from aircraft services.
$3.5 billion. Wow. What did that include?
Well, you've got Gulfstream's own large maintenance business. Things like warranty work, part sales affect that. Then there's jet aviation.
Right, jet aviation. They do MRO.
MRO, yeah. Aircraft completions for bigger jets, narrow and wide body. They run FBO's fixed base operations, though volume there was actually down a bit in Q2.
Okay. And aircraft management.
Yep, they manage over 300 aircraft for owners. So the specific mix of all those different services, that also really swings the overall segment margin from quarter to quarter.
Okay, so a lot of moving parts on margins. But underlying demand for the jets themselves sounds really strong.
Very strong. They proved it with that 1.3 book-to-bill in aerospace for the quarter.
1.3x book-to-bill. Still bringing in more orders than deliveries.
Right, and they fully expect the G800 getting certified, performing well, those early deliveries. That's all going to stimulate more demand.
across the board, or mainly for the new models?
Seems like across all models, actually, led by the 700 and 600, but strong interest generally. And good geographic spread too, US, Europe, Middle East, other regions.
And do they have the capacity to build more if demand keeps growing?
They say yes, Gulfstream has the plant, the equipment, the people. They have the capacity to produce 200 planes a year if needed. They'll scale it based on what the market actually demands, so they're ready.
Okay, so aerospace is navigating transitions, but demand is strong, capacity is there. Let's pivot now down to the ocean. Marine systems. I heard that's where a lot of the growth is coming from.
Oh, definitely. The growth story continues, was the phrase used, and the numbers back it up. Revenue was $4.22 billion.
$4.2 billion. How much was that up?
Significantly, up 22.2% from last year, and even up 17.6% just from Q1. Real momentum.
Huge growth. What about earnings?
Operating earnings hit $291 million, up 18.8%. The margin was 6.9%.
6.9% margin. So still room for improvement there compared to other segments, but the top line growth is impressive. What's driving it?
It's mainly the big submarine programs. Continued construction on the Columbia-class ballistic missile subs and the Virginia-class attack subs, plus a slight uptick in DDG-51 destroyer work.
Those are massive long-term programs, and the backlog must reflect that.
Hugely. Backlog in Marine jumped by $14.6 billion. That's a 38% increase.
$14 billion increase in one quarter.
Yeah. Pushed the Marine backlog to almost $53 billion.
$53 billion. What drove that massive jump?
It was largely one big contract award for 2 Block V Virginia-class subs, and one of those is a unique special mission ship with a lot of extra content.
Okay, a major contract win. But there was something else interesting about that contract, wasn't there? About investment.
Yes, exactly. What's really fascinating is the contract also included specific funding investment funds to support shipyard productivity, wage increases, more training programs.
So money aimed directly at strengthening the industrial base.
Right. It complements other funding from the Navy and Congress trying to stabilize and improve the whole submarine supply chain. The goal is to, boost throughput, get more productive. It's a strategic investment alongside the actual ship order.
That's crucial because we still hear about supply chain challenges in shipbuilding, right?
We do. They acknowledge persistent delays and quality problems, late materials, late parts, quality escapes that mess up the workflow. It's still an issue.
But are they making progress?
They say they are. They're developing good workarounds, making progress, and working really closely with the Navy and the administration on it. But it's clearly an ongoing focus area.
Okay. There was also a mention of an issue at NASCO. Something about an unfavorable EAC adjustment.
Ah, yeah. The estimate at completion, the EAC, they had to increase their cost estimate on a program there, which they called extremely unusual.
What happened?
It was mainly due to a flood that impacted their main production line, caused a bunch of rework. They think they'll be mostly past it by the end of the year.
Okay, so a one-off event, hopefully. What does NASCO mostly do?
They mainly build auxiliary ships for the Navy support ships, logistics ships, and demand for those is actually going up. So this adjustment was more of an unexpected hiccup.
Got it. While we're on shipbuilding, there was that comment from the Secretary of the Navy about potentially having Electric Boat and Huntington Ingalls each build Virginias separately in the future. Did GD comment on their capacity for that?
They did. Electric Boat's position was pretty clear. Skilled labor is not the constraint for them. They feel they can support additional growth if that's the direction things go.
So they can handle building more submarines.
They believe so. They said they'd need some additional capital, but not, quote, an enormous amount. But ultimately, they're deferring to the Navy on those bigger strategic decisions about the industrial base.
Okay, so Marine has huge growth, big backlog, but also supply chain and efficiency challenges they're working through. Let's switch gears to combat systems. Their story seemed more about discipline.
Yeah, operating discipline was the theme there. Performance was solid. Revenue was basically flat year over year, $2.28 billion.
Flat revenue. But earnings?
Earnings were actually up 3.5% to $324 million, and the margin increased by 50 basis points to 14.2%.
Okay, so better profits on flat sales. That shows that operating leverage they talked about. How are they managing that?
Well, it's kind of a tale of two markets for them right now. They're seeing really strong growth over in Europe.
Europe's defense spending is ramping up, right?
Exactly. Huge potential there. Their European business had a 1.5 book-to-bill in the first half. Really strong.
But that growth was offset by
Lower volume in the U.S. combat vehicle side, and that was mainly driven by the cancellation of the Army's Booker program. So Europe up, U.S. vehicles down, netting out to flat overall revenue.
And how are they adapting strategically, investing for the future?
They mentioned they've invested ahead of need to support key priorities, like the rapid development and fielding of the next-gen main battle tank, getting ready for what's next.
Makes sense. What about munitions? That's always a hot topic.
Big focus there, too. They're expanding facilities, increasing production rates for artillery projectiles, the load assembly, propellant really pushing to support the Army's goals for higher output.
Okay, combat systems managing effectively. Let's cover the last segment. Technologies. GDIT and mission systems, how do they fare?
Technologies had another strong quarter overall. Revenue hit $3.5 billion, up 5.5%.
Solid growth. Earning.
$332 million, up 3.8%. The operating margin was 9.6%, dipped just slightly 10 basis points.
Why the slight dip in margin?
It's mixed. GDIT, which tends to have slightly lower margins than mission systems, grew a bit faster in the quarter, so it pulled the average down just a tiny bit.
Okay. And what's the environment like for GDIT specifically? It's a huge IT services provider.
Yeah, Amy Gilliland, who runs GDIT, described it as a particularly dynamic environment. Contract award activity across the government was actually slower than normal in the first half.
Slower awards. But GDIT still performed well.
They did. Despite fewer decisions from customers, they still pulled in 6 big wins over $100 million, including one over $1 billion.
$1 billion win. Nice.
Yeah. And their first half book-to-bill was essentially 1 times, even with a protest holding up another big Q2 win. So they're definitely competing effectively.
In that tougher market, what's giving them the edge? What's their strategy?
What seemed really key was their investment in what they call digital accelerators.
Digital accelerators. What are those?
Capabilities that leverage things like AI, cyber, advanced mission software. And they're also focusing on deepening relationships with tech partners, both established and emerging ones.
So bringing the latest tech to government customers.
Exactly. Being that reliable partner who can integrate the best stuff out there, that seems to be the core of their advantage.
Okay, that's GDIT. What about mission systems, the other half?
Jason Akins said mission systems had a great quarter. And importantly, they're in the final year of a transition.
A transition from what to what?
Moving away from some older legacy programs that had lower margins and shifting focus to new, higher growth franchises.
And are they seeing results from that shift yet?
Yes. He said they're starting to see an inflection to growth now. And like GDIT, they've been investing ahead of need.
Investing in what areas?
Things like unmanned platforms, smart munitions, high-speed encryption, strategic deterrent systems, contested space capabilities, really future-focused areas.
And is that translating into opportunities?
It seems so. Their total backlog in mission systems is up 15% year over year, and the potential contract value is up 23%.
Yeah.
So demand looks strong for their newer offerings.
Okay, lots of positive signs in technologies, GDIT winning, mission systems inflecting. Why did they keep the full-year guidance for the segment unchanged then?
It mostly comes down to timing and predictability. They mentioned the fluidity in that market and the pace of adjudications, basically, how quickly contracts actually get awarded.
So even if they're winning, the timing can be lumpy.
Exactly, especially with some of the high-speed encryption products, which can be more transactional. So keeping the guidance steady seems like a prudent move, given that uncertainty around award timing.
Makes sense.
Okay.
Let's zoom out again. Look at the whole company orchestration. There's a new leadership role, right?
Yeah.
Danny Deep as EVP for Global Operations.
Yes, that's a new position. Danny Deep. His job is basically to further optimize their operating leverage
Optimize leverage.
by driving continuous improvement across the whole value chain, from how they bid on contracts, making sure that's disciplined, to strengthening the supply chain, making manufacturing more efficient.
So really digging into the operational details across all the businesses.
Yeah, and putting a special focus on programs where they're facing challenges to get them up the learning curve faster. It's about really doubling down on operating discipline and execution.
Which should help with margins, especially maybe in marine systems.
That seems to be a key goal, yeah.
Well,
Putting a finer point on operations everywhere, but likely with a close eye on improving marine margins.
Okay, so new operational focus. How does this all roll up into their updated outlook for the full year for 2025?
They've definitely become more optimistic. They raised their revenue forecast significantly, now expecting around $51.2 billion for the year.
$51.2 billion. How much higher is that than before?
It's an increase of $900 million over their prior estimate. Pretty substantial bump.
Wow. What about overall margins? Did they raise that too?
They actually held the overall operating margin forecast constant at 10.3%.
Held margin flat despite higher revenue.
Okay.
Pet cash.
They did increase their cash estimate for the year, didn't give a specific number in the summary, but higher cash generation expected.
Okay. Higher revenue, steady margin, better cash. What does that mean for the bottom line for EPS?
They raised the EPS forecast too, now expecting $15.05 to $15.15 per share for the full year.
$15.05 to $15.15. So clearly feeling confident.
Yeah, the CEO's final comment really captured it. They feel very good about the potential for the year. It sounds like they're in a strong position.
Definitely seems that way. And just to round out the financial picture, any other key activities we should mention? Shareholder returns.
Right. Just to reiterate, they paid out $785 million in dividends in the first half and did the $600 million in share repurchases. So balancing investment, debt reduction, and shareholder returns.
Okay. There was one other item mentioned, a legal matter, something to keep an eye on.
Yeah, a legal watch point. There's a class action lawsuit involving naval architects and marine engineers.
What's the status?
Well, the district court initially threw it out, but then the Court of Appeals reversed that decision and sent it back for further proceedings.
So it's ongoing. What's GD saying?
They're defending the case, naturally. They stated they can't estimate the potential outcome or loss right now, but they did note it could potentially have a material impact.
Okay, so just something to be aware of, an uncertainty out there.
Exactly, just part of the landscape for a company this size.
So let's bring this all together. What does this deep dive really offer you, the listener?
Well, I think it's a pretty privileged look, really, into how a huge, complex company like General Dynamics actually works. How they manage growth, handle innovation, deal with challenges across so many different high-stakes areas.
Yeah, you see how those granular operational improvements they're talking about, those strategic investments, how they actually translate into the big financial numbers?
Right. And it really highlights that interplay between government defense spending, technology shifts, and the global market demand, especially in aerospace. It's all connected.
It definitely shows the complexity of operating at this kind of scale.
Which leads to maybe a final thought, something for you to mull over.
Go ahead.
Given this tricky balance, right?
Yeah.
Domestic defense needs, accelerating international defense spending, that super competitive business jet market.
Right.
How might GD's big bets, their investments in AI, advanced manufacturing, those new planes like the G800, how might that shape not just their future, but the whole landscape of national security and even global commerce in the next few years?
That's a great question to ponder. How these strategic choices ripple outwards. Well, hopefully this deep dive gave you some valuable clarity and insight into General Dynamics' quarter and their path forward. Maybe think about what stood out most to you, how these themes might play out elsewhere. Thanks for joining us for this deep dive.